Welcome to another weekly Friday chat. This week, we're going to be discussing the inverted yield curve. What is an inverted yield curve, you ask? Stay tuned. Okay, so when you're talking about an inverted yield curve, as you can see from this chart, essentially what it means is that short-term rates are paying and earning more than longer-term rates. Normally, when you're investing, especially in the bond market, you're rewarded
and you will be rewarded
for going longer out on the curve. The curve is considered, the curve, which is these lines right here. That's kind of considered the curve, and then the curve is longer out. So longer out on the curve is 1, 2, 5, 10, 15, 20. So in normal environments, a 1-year treasury or bond is paying much lower than a 20 or 30-year treasury. But we'll see from the charts that that's not the case right now. So look at the chart that I have up here right now. This is basically the green line is a 10-year treasury, and the red line is a 2-year treasury. Just like I mentioned, the 10-year treasury should normally be paying above or well above a 2-year treasury. Well, as you can see, the red line is higher than the green line. So the 2-year treasury right now is paying 3.9%. where a 10-year treasury is paying 3.43%. So hence the curve is inverted, which means that it's the opposite. If we look at this chart right here, this is actually comparing the 10 and 2-year treasury notes to see when the curve is inverted or when it has gone inverted in the past. And you can see this is a 5-year chart. And only 2 other times besides where we are right now, we're inverted, where we're almost about a 0.5% difference between what a 2-year and 10-year is paying. And as you can see here, the curve went inverted back at the beginning of 22. Then it kind of reversed itself. And then ever since about the summer of last year, it's been inverted ever since. And the only other time in the last 5 years that it was inverted was halfway through 2019. So when we hear, or I've even written about it, or when you hear the curve is inverted or you're getting paid more for shorter term debt, that's exactly what they're talking about. Another way to look at it is this is the Schwab trading screen. So I'm able to go in here and purchase these securities, treasuries, and you can even see CDs on here as well. So normally a 3-month treasury right now is paying 5.15%. And if you went out all the way to 30 years, it's only paying 3.7%. That's a huge steep on the inversion. And what it's telling you is that you're not rewarded for going longer out on the curve. Why are you normally rewarded for going out longer is because there's more interest rate risk. There's more bond risk. So when you're longer out, a change in interest rates has a much greater impact on the value of your bond. So if interest rates go up, your bond prices will go down. If interest rates go down, your bond prices will go up. That has a much more dramatic effect the longer out you go. It's called duration. And what duration means is that for every 1% interest change, how much the value of your bonds go up and down. So the longer you are out on the curve, the more duration interest rate risk you have. The shorter you are, the less duration interest rate risk you have. So right now, you're being rewarded with less risk, which normally when you're talking about an investment market, that's not the case. You can see here, we got a 3-month treasury paying 5.15, a 6.5, 9-month is 4.89, and so on and so forth. And you've got CDs, which are FDIC insured, paying, a little bit more than the treasuries depending on where you are on the curve. Treasuries are not FDIC insured. They are backed by the full faith and credit of the U.S. government, but they are not FDIC insured. All right, that's a wrap on another Friday weekly edition, inverted yield curve style. Like I said, I wanted to kind of jump on here and go over what an inverted yield curve means. And then also to let you know that if you have cash in the bank or your bank account, you feel like you're not getting competitive rates or you need help figuring out kind of how to ladder it or, layer it with what the money market's paying and what they're offering with CDs, let me know. We can review that for you and see what we can figure out at the bank. If the bank isn't offering anything competitive, which they should be, then we can always open up a cash alternative Schwab account, which is a fancy term for just opening up a regular account and labeling it cash alternative, because that account is really earmarked only for cash alternatives, kind of layer short-term laddered treasuries or CDs. So hope you found this helpful. Remember, it's Fridays, it's pizza night. Until next time, see ya.